Welcome to the Deep Dive. This morning, we're jumping into the fiscal 2025 third quarter earnings call from the fast food giant Wendy's.
Yeah, and there's a lot to unpack here. They've detailed this pretty significant turnaround plan they're calling Project Fresh.
Right. So our focus today is really getting straight to the essential takeaways, the key numbers, the strategy shifts, what management actually said.
And try to understand why the market reacted the way it did.
Yeah.
It wasn't straightforward. Our mission is basically to connect the dots between the call and the stock's movement.
Okay, let's start with that initial reaction then. People were calling it a relief rally.
Yeah.
Why relief?
Well, because the headline numbers, they came in better than feared.
Yeah.
Adjusted EPS was $0.24. The consensus was expecting more like $0.24. So a solid beat there.
And revenue too.
Revenue as well came in at $549.5 million, also ahead of the 534 million range people were looking for.
So a clean beat, top and bottom line, that usually gets things going.
Exactly. It definitely provided some immediate relief, especially, given how tough things are in the quick service restaurant space right now, the QSR world.
But wasn't there something else positive? I thought I saw something about cash flow.
Good catch. Yes. A really key positive signal was they actually raised their free cash flow outlook for the full year.
Okay.
They're now expecting somewhere between $195 million and $210 million. And that increase, well, it seems to be mostly driven by dialing back some capital spending. A bit leaner there.
So better earnings than expected, more cash flow expected. Sounds pretty good.
It does on the surface.
The stock's initial jump didn't really hold, did it? It faded pretty quickly.
It did. And that fade, that's really telling. It signals that investors, while maybe relieved by the headline numbers, were quickly weighing those positives against some pretty significant operational challenges that came out in the call.
Okay, so let's dive deeper then. This sounds like that classic tale of two businesses scenario.
That's exactly it. You've got this divergence. On one hand, the overall global same restaurant sales were down 3.7%.
Which isn't great.
No. And the real drag, the main reason for that, was the U.S. market. Comps there dropped a pretty hefty 4.7%.
Wow, okay. Why such a drop in the U.S.?
It seems to be that double whammy we're seeing elsewhere. The value-conscious consumers pulling back, maybe visiting less often.
Right.
And then you layer on top these really intense value wars happening across the whole fast food sector. Everyone's fighting for that same customer.
And when traffic drops like that, margins must take a hit.
Oh, absolutely. You really can't avoid it. Their U.S. company-operated restaurant margin be contracted by 250 basis points compared to last year, landed at 13.1%.
250 basis points, so 2.5 percentage points lower. That's substantial. Did they say what was driving that specifically? Costs?
Yeah, they were pretty upfront about it. Pointed to ongoing inflation pressure, specifically on booth and on labor costs. Those are still biting.
So much so that they had to update their inflation forecast for the year.
They did. Now expecting commodity inflation around 5% for the full year.
Yeah.
That's a persistent headwind eating right into the profits.
Okay, so the U.S. picture sounds, well, pretty challenging, but you said a tale of two businesses. What's the other side?
The other side is international. And it's frankly a completely different story. It's really the engine right now.
How so?
International delivered really strong system-wide sales growth, 8.6%. And same restaurant sales were up a healthy 3.0% there.
Okay, so positive comps internationally while the U.S. is negative. That's quite the split.
It is. And it's not just comps. They're seeing good momentum with unit growth, too. They mentioned hitting milestones in Ireland and Australia, plus new long-term deals like 50 restaurants planned for Central Mexico. International is really humming along.
Interesting. Let's circle back to the U.S. then, because you flagged something before we started recording. This huge difference between the company-owned stores and the franchises.
Yes. This is, I think, one of the most critical data points from the whole call. While the overall U.S. system was down that 4.7%, the restaurant's Wendy's operates itself. They only saw comps decline by 0.7%.
Right. Only 0.7% down versus 4.7% down for the system average. That means the company stores outperform the franchisees.
All 100 basis points. Yeah. 4%.
Wow. That's a massive gap. How did management explain that? How are their own stores doing so much better in the same tough environment?
Well, they attributed it to what they're calling operational excellence. And interestingly, they said about 75% of that 400 basis point difference came from better traffic, not just higher prices.
Better traffic. So what does operational excellence mean in practice?
It means things like better crew training, which leads to higher customer satisfaction scores. They mentioned specifically improvements in order accuracy and staff friendliness.
Okay.
Plus the rollout of technology. Things like digital menu boards inside and out, and the fresh AI automated ordering technology in the drive-thrus. The company's stores are basically running tighter ships.
Which I guess leads us directly into the strategy discussion. If your own stores are doing that much better, you need a plan to get the rest of the system up to speed. Is that what Project Fresh is about?
That's the core of it. Project Fresh isn't just tweaking things. It's a fundamental strategic shift for the U.S. business. They're explicitly moving away from just chasing net unit growth.
Right, opening more stores.
And instead, they're prioritizing average unit volume, AUV, getting more sales, more profit out of each existing healthy location.
Okay, prioritizing AUV, how do they plan to do that? I saw headlines about store closures.
That's the most eye-catching part of it, the system optimization pillar. They announced plans to close between 200 and 350 locations in the U.S.
2 to 350, that's a lot. That's a decent chunk of their footprint.
It's a mid-single-digit percentage, yeah. It sounds drastic, and it's definitely grabbing headlines. It's that classic shrink-to-grow strategy.
Shrink to grow. But closing stores can look like weakness? How are they framing it?
They're framing it as removing a drag. These are described as chronically underperforming locations that are hurting both the brand image and the financials of the franchisees who operate them.
So cut the weakest links to strengthen the average.
Exactly. The idea is it frees up capital and management attention for the franchisees involved, allowing them to reinvest in their remaining healthier locations, maybe in better trade areas. They're actively encouraging this trade-off. Close the bad one, reinvest in the good ones.
That focus on prioritizing investment makes sense with the AUV goal. Does it show up in their own spending plans too?
It does. They specifically cut their planned capital expenditure in their spending on building new locations for franchisees. The revised range is tighter now, $135 million to $145 million.
So less money on new buildings. Where's that capital being redirected then, if it's focused on AUV?
Primarily towards technology and marketing effectiveness. On the tech side, think things like better systems in the kitchen to manage orders, enhancing their digital apps and online ordering. And on marketing, they're investing in a really deep customer segmentation study, using more advanced data analytics. They kind of admitted their current value offers, like the $5 biggie bag.
Which are popular.
Right. Popular with existing customers, but maybe not doing enough to actually bring new people in.
Yeah.
So they want to get smarter about targeting different consumer groups with the right message, whether it's value or quality.
Speaking of marketing and bringing people in, they seem pretty excited about a new product launch in Q4, didn't they? Chicken tenders.
Ah, yes. The tendies, as they apparently call them. They were definitely bullish on that launch. Management framed it as a big success right out of the gate.
How successful?
Apparently, demand was so strong initially that some places actually sold out, even before the big national advertising push really kicked in.
Interesting. So they're positioning these tendies as a key piece to build momentum heading into next year.
That seems to be the plan. It's a new core menu item they hope will help stabilize traffic and sort of kickstart this AUV growth strategy for 2026.
Okay, so you've got these big strategic shifts, the store closures, the U.S. struggles. But they didn't actually lower their overall guidance for the year, did they?
No, they held the line there. That's a sign of confidence, or at least commitment. They reaffirmed the full-year adjusted EPS target of $1.82 to $6.89 and adjusted EBITDA between $505 and $525 million.
And unit growth, still positive overall.
Still expecting global net unit growth between 2% and 3%. But, with potentially 350 U.S. closures in the mix, you'd have to assume it lands towards the lower end of that range.
Okay, so putting it all together for someone tracking this, you have a classic turnaround playing out. Short-term pain, like the store closures and the rough U.S. comps, for hopefully long-term gain with healthier AUVs. The big question is when? When does this start to turn?
And management actually addressed that directly. They basically signaled that the fourth quarter, the one we're heading into, will likely represent the bottom, the trough in performance.
They expect Q4 to be the low point? Why?
A couple of reasons. They're up against really tough comparisons from last year. And also, it sounds like you're deliberately simplifying their marketing and promotional calendar for Q4.
Simplifying, pushing things out.
Yeah, kind of clearing the decks, pushing some initiatives into 2026. The idea seems to be, let's focus laser-like on executing the core plan now, especially getting the tendies launch right.
Yeah.
That launch is really positioned as the main thing to start building momentum out of that Q4 trough and into next year.
Let's talk about risk for a second. Franchise health. Closing 350 stores suggests some pain out there. Management says the system is healthy overall, but how much stress is there really?
That's a key question. They did acknowledge what they called pockets of more acute financial pressure. The system optimization, the closures, that's meant to address those specific pockets.
So it's not seen as a system-wide crisis, but targeted relief.
That's the narrative. But look, the entire success of Project Fresh hinges on this. It relies on the franchisees whose weaker stores are closing, actually taking that capital and redirecting it effectively into their remaining stores.
To try and replicate that 400 basis point outperformance the company stores are seeing.
Exactly. And doing that across a large, diverse franchise system, that is a massive execution challenge, no doubt about it.
Okay, let's shift gears then. Thinking about this from an investor or market watcher's perspective, management says Q4 is the bottom. They have this aggressive plan. Where might the market be getting it wrong, or where could an opportunity lie?
Right. And just to be crystal clear here for everyone listening, what we're about to discuss is purely based on the information from the earnings call and related analysis. It's for informational purposes.
Absolutely. This is not financial advice. Okay, disclaimer delivered. What's the setup?
The setup is the stock's well off its highs. That initial relief rally after the earnings beat faded fast, that tells you there's deep skepticism out there about whether management can actually pull off Project Fresh, especially with inflation still sticky and the consumer may be weakening.
So the market's focused on the negatives, the execution risk.
Heavily. Our thesis, or rather a potential way to look at it, is that the market might be overly focused on the U.S. struggles, treating it just like any other challenged consumer discretionary stock right now.
And what are they potentially missing?
They might be mispricing or underappreciating the combination. You've got that very successful, growing international business combined with this really aggressive, systematic plan to fix the U.S. business by boosting AUV and franchise hit health. It's not just a struggling U.S. story.
Okay, so if you believe that the market is mispricing that potential AUV turnaround, what's an, let's say, outrageous but plausible way someone might think about expressing that view?
Right. Keeping the not financial advice hat firmly on. This would be an aggressive bet on execution. You could structure it as a long position using long-dated call options, and these expiring, say, 15 months out.
Long-dated calls, betting on a longer-term recovery. What's the core idea behind that specific structure?
The core idea is that if Wendy's can actually deliver on Project Fresh by, let's say, sometime in 2026, if they stabilize those U.S. comps, get AUV moving up, and crucially, keep converting over 100% of their net income into free cash flow like they often do,
then the stock should be worth significantly more than it is today.
The argument is the stock should re-rate well above its current trading range. The options give you leverage to that potential upside over a longer time frame.
Okay, that makes sense. What makes it outrageous?
The outrageous part is just how much relies on execution, particularly on the brand side. You're basically betting that the Tendies launch and whatever marketing they cook up for 2026 will be so effective that they can genuinely overcome those persistent commodity and labor cost headwinds that really hammered margins this past quarter.
So it's a bet that better marketing and store operations can win the value fight where just cutting prices hasn't worked as well lately?
Precisely. It's a strong bet on brand revitalization and operational discipline winning out over the near-term economic pressures. A big bet on Project Fresh actually succeeding.
All right, that definitely gives us something to think about. Let's wrap up this deep dive into Wendy's Q3. We hit the earnings beat.
Yep, the relief rally that faded.
The huge difference between the struggling U.S. business and that strong international growth.
And of course, the details of Project Fresh, including closing up to 350 U.S. stores as part of that big pivot towards AUV.
We saw that striking 400 basis point gap where company stores are outperforming franchises.
And really, the whole story now boils down to whether management can successfully scale that internal playbook, that operational excellence, across their much, much larger franchise system. That's the challenge.
Which brings us to our final thought for you, the listener. Management pointed to the new chicken tenders as the catalyst starting in Q4. But if you're watching this turnaround story unfold, what other signs would you look for? What are the earliest leading indicators beyond just saying Tendy sold well that would truly convince you that AUV growth is taking hold and Project Fresh is actually working?
Is it maybe seeing franchisees increase their own reinvestment rates? Or perhaps the specific improvement in the free cash flow conversion metric? Or something else entirely? That's your next research rabbit hole to explore.